income today, and let's move on to the socials. Okay, yeah, so stay connected with us. We're on Slack. All of us are on. So if you want to talk about stocks, you're going to be a SMIC Plus member, uh, all that stuff, join the Slack. If that link doesn't work, shoot one of us an email and we can send you a new one.
Yep.
All right, let's go. All right, so no more other links. We just have our link tree, and our link tree will have all of our links to our socials, where we'll have our SMIC calendar of events, our Zoom, our Venmo, our Slack, website, YouTube, Instagram, LinkedIn, all that stuff just on one link. So make sure to pull out your phone, scan it. It's also on our Instagram as well. And then SMIC Plus, you want to talk this one, Brian? No, no, no. Go. All right, I'll do it. So join SMIC Plus. You will be giving out free shirts, reduced prices on the stools. We'll be able to do monthly mixers with the team, the BAM team, priority access to all the industry mixers that are coming up. We have a dedicated Slack channel where we post internships, resume reviews, and other resources. We got some summits coming up that we posted. This will all be going to support the club. So
Yes, and
you want to add to
also
that?
I just had one announcement for that too. Is we're gonna start getting shirt information because we will be trying to put in orders for our shirts. So if you want your shirts, get your SMIC Plus membership. We'll try and get that Google Form data uh, to get that information in like the next day or so, and we'll set a deadline for that. So stay on the lookout for that. Please join our Slack for more information. Cool. So today we will be doing fixed income. Next week we got finance jeopardy. So come join us. Take a little de-stressing from finals or whatever, or
Mm-hmm.
midterms. We're gonna do games and we'll have cash prizes for the winners. And then after that, we'll do Bloomberg valuation. So we'll try and walk through some of the Bloomberg tutorials for how you can do valuations, how you can use some of those Bloomberg fields on Excel if you want to automate those DCFs. And then the week after that, which I think will be the week just before spring break, we're gonna have a little Q1 update for BAM. So BAM's like year-to-date returns and whatnot, and then we're gonna have like speeches for who's running for e-board, the top e-board positions next year. So that's what we got in store for you guys. All right, so today we're going to be going through the basics of fixed income, basics of bonds, and then Ethan is going to walk through some of our strategy and look at the historical performance of bonds. And then we're going to have Allegra talk about green bonds. Cool. So without further ado, also, if you have any questions, feel free to put them in the Zoom chat and we'll try and get to them afterwards. Cool. So let's start with the basics. What is fixed income, right? So there's a lot of financial terms, financial jargons in terms of fixed income, but it's essentially just a loan. And this can be for corporates, corporations, or governments. Um, the reason they're called fixed income is because they pay a fixed like coupon or fixed payment, right? So that's usually has to do with its yield. And some of the benefits are its diversification. It's a great capital preservation asset. So compared to equities, right, you can use fixed income like some of those shorter term uh, T-bills to hold instead of cash if you want to hedge against inflation. And another reason is because of the income, right? So instead of like equities where you might have to either take out a loan on your equity position to get cash or sell it to get cash, with fixed income, you can cash in that coupon, or you might just get it directly deposited into your account, depending on if you're a registered um, owner of that bond, or if you have to like clip a coupon and mail it in. But that's how it is historically been used, as it's a great investment tool for if you want to have like income, right? So it's similar to like a loan, but it's a different asset class from equities, because the bond market is actually a lot bigger than the equities market. So I think some of the numbers that I was looking at was that the bond market is about 40 trillion compared to about 20 trillion equities. So it's obviously a much bigger market. And this has to do with the fact that these bonds have so many different characteristics, which I think I'll walk through in the next slide. So, equities, it's basically just the common stock or maybe the preferred stock. Um, but bonds, you have many different terms, uh, many different seniorities. So you can have like senior or junior loans, and you have them at different yields. So however many securities you think are out there, there's probably 100 more bond or fixed income securities. So, and then obviously it's important to the main difference that people like bonds, I like fixed income, is because of the drastic risk profile from equities, right? So we all know how volatile equities can be, and the risk profile is just much more different, right? So if you have a corporate bond, then if that underlying security defaults, you're kind of the first one, or you have a higher priority to recoup your investment than an equities investor. So that's why a lot of investors like it. It's in that way, it's a lot less risky. And then if you have a government bond, it's just much more in that way, right? So you have Jerome's money printer that can print money for you and make sure that you recoup your investment, essentially. So it's backed by the full faith of the government. So that's kind of the basics. Let's go to the next slide. Ooh, I don't know if this looks good or if it's a little blurry. But essentially, the components are maturity, duration, yield to maturity, the coupon, credit quality, and another component that affects bonds a lot is the federal funds rate, obviously. So maturity, right? This is the term length of the bonds. So essentially, it can be a short-term bond, intermediate, and long-term, and that's just categorized but by the length of that term. So usually, a short-term bond is anything between like a year to 3 years, and intermediate 1 to 10. And then you look at these long-term bonds that are usually like 10 to 30. They used to have 100-year bonds. Um, Maybe some other countries have that still, but yeah, that's what maturity is. It's just pretty simple. It's just the time length of the bond. And then duration, right? So this one's a little more complicated, but essentially duration is the how you measure the sensitivity, or it's how sensitive it is to a rise in interest rates. So an example would be a bond with a duration of 6 years would be twice as sensitive to a rise in interest rate than a bond with a with a duration of 3 years. So that's essentially how you can look at duration. It's just how sensitive it is to changes in interest rates. And then you have yield to maturity and coupon. So this is the part that you as an investor will probably um, pay more attention to, because this is how much you're going to get paid out. And so yield to maturity, it's the percentage rate of return for a bond until you hold it to maturity. So yield rises and falls depending on the market value. And coupon is, of course, it's the annual amount the interest holder will receive. So it's the actual income that you will receive as that bondholder. And then another thing that we look at, especially when we're comparing bonds, is credit quality, especially for corporations. Uh, Usually that this will be in terms of the ratings by certain credit quality agencies or rating agencies. And it goes basically from investment grade to non-investment grade. And the way you want to look at this is you obviously want to have these higher quality corporations that you're invested in that are usually like double A, or anything I think above double B is investment grade. So this is what how you can measure the company's credit worthiness. And then this is actually put out by the rating agencies. So you don't have to calculate that yourself. And then the federal funds rate, that's obviously important. This is the target interest rate set by the FOMC at which commercial banks can borrow and lend excessive revenues overnight. So um, this has a large influence over short-term rates and the use of money supply to move interest rates towards that target rate. So these are all things that we look at when we are comparing these different fixed income securities. And these are some of the terms that you might want to know. All right. So let's look at some of the most common types of fixed income assets. So like I said, you have your US treasuries, you have your corporate bonds, preferred stock, and yeah, let's just look at those three. So preferred stock it is a stock, but it pays a dividend. So you can think of it as a fixed income security. I know some people have had reached out to me if like they had questions on is a preferred stock an equity. Since it works, since it pays a fixed amount, you should probably consider it more of a fixed income security, and you should compare it more to bonds, right? So, like I said before, these type of fixed income securities can be further classified by their maturity, so their term length, and then another way you can classify them is by their risk. So. The treasuries are considered risk-free since they are backed by the government. And then you can look at investment grade, right? So their credit quality. And these higher yield fixed income securities are generally considered junk bonds. But if you are looking for a higher yield and you believe that the company can repay its debt and you're willing to kind of sit through that and get a higher yield, especially in a lower interest rate environment, then you can look at these so-called junk bonds, right? All right. So here I want to touch on just the relationship between fixed income and equities. So historically, here we have basically a regression or regression of the Russell 3000 and the aggregate treasuries. So this kind of scatter plot here, if you look at that orange line, that's it's kind of sloping downward. So what that tells us is that there's historically been a reverse correlation between U.S. Treasuries and equities, and what that's essentially saying is that most investors like to hedge their equity positions with some form of fixed income securities. Traditionally, it's been used as a cushion. So there's that 60-40 portfolio that many asset managers used to follow, right? That's pretty conservative, where that 60% in equities is cushioned by that 40% in maybe like an aggregate bond index. And that way, if you see any large drops in your equity positions, those can be cushioned off for like um, your bond section will kind of counterweight that. So you kind of hedge against that. So what I want to talk about in this specific area is, if you look at kind of the headlines in the past weeks, you can see that except for probably last week, they've equities and bonds have kind of been moving directly. They've kind of been moving more explicitly together. So you see a rise in bonds, but you also see a rise in equities. Um, so after researching that, most people would say it's because of the Fed and what Fed's doing in the markets, right? So obviously with the pandemic and the kind of what we saw earlier last year, which could have been a pretty deep recession, the Fed stepped in, went into the bond market, bought aggressively, kept interest rates low, and so it's been essentially propping up the bond the bond market. And because of that, these equity investors, they feel a lot more confident in the Fed protecting them. So they've also been piling into equities, right? I mean, there's a lot of arguments on why else they're going into equities, right? So you look at those tech stocks that have been booming, and some could have been just because of like the fundamentals of those tech stocks that they're better positioned for this work from home virtual environment. But if you're wondering, well, why isn't this reverse correlation happening now? You know, this is an explanation that a lot of people are kind of jumping onto, which is because the Fed's pushing up the bond market, that's being stabilized. But because they see that the Fed will come and help out the markets if need be, that's also giving more confidence to these equity investors. And so you kind of see both of them moving up at the same time. Now that being said, if you saw last week, there's kind of like a come to earth moment for equity investors where we saw like interest rates rise somewhat aggressively, and we'll see it in this graph here. And then you saw that the stock market dipped right into Friday, and it was up yesterday, but it dipped into the end of last week. So the reason for that, which a lot of people are saying, is let me go back actually. So this here, this green one, this is the current treasury yield curve. So here we have the shorter term over here and the longer term over here. Now this, oh, sorry. Now this yellow one right here, this is that same yield curve. I don't know if you can see this date, but that's from last year, from last March. So you saw that shorter term were higher, right? Actually, going into 2020, there was some conversations of what that inverted yield curve meant, right? So this is what they were talking about. This is not super healthy, right? When interest rates are equal to shorter term, when long term rates are equal to short term rates, this causes people to, especially corporations, to borrow more at the longer term of the spectrum. And so many people say that could create like a credit bubble because they're taking out a lot of loans because it's cheap. So when the Fed came in and dropped these shorter term interest rates, because this is what they have more control over the short term, right? So they dropped these down, and this is kind of where we're at now. Now the movement was here, so this is that same comparison, but this is the move from yield curves from a month ago till now. So you see, what is this, like a 30 basis point move in the 10-year? So pretty, I guess you could say drastic, you know, compared to historically move, pretty big jump in just a month. Right. So there was that come to earth moment for equity investors that say, okay, well, interest rates are moving up, right? So that was kind of bearish for equities, but didn't really live too long because we're up now again. But this is kind of how like bonds and the fixed income market really play a role in the market as in general. So I'll definitely love to see if I can clarify that further, and if you guys have any questions later. But if not, we'll be moving over to Ethan to talk about how fixed income has been performing.
Awesome. Thanks, Brian. So my name is Ethan. I was kind of in charge of like fixed income last semester. So people would like come to me with like questions and stuff. And I don't even know how that happened, but it happened. So I'll be talking to you guys about the different indexes that we analyzed and our strategy for last semester with the fixed income market. So I'll just start off with the US market with this graph right here. It's showing the returns over 20 years, and it averaged out about 5% with a standard deviation of 3.4%. Some things I wanted to point out, though, is let's look at year 2000. It has the highest return at 11%. And that was because in the year 2000, interest rates had actually dropped by about 1%. And so when you think about it, say in 2000, I had a bond, and then interest rates dropped to like by 1%. Now you're holding a bond at a premium. And so that's why you're going to be able to have a higher return, especially when interest rates drop by 1%. That's a huge amount. Inversely, though, if we look at 2013, interest rates had risen by, I think it was like 50 basis points. I can't really remember, but the opposite happened. So say you have a bond in 2013 and then interest rates were going to rise to by like, 50 basis points. Now you're holding a bond at a discount. And so you've lost money. So essentially what I want to point out here is that when interest rates drop, you're going to be getting a higher return. And when interest rates go higher, then you're going to be losing money. And so this was kind of the state this is what we were looking at when we were looking at 2020. Back last semester, interest rates were like near zero. And so when they're near zero, there's really only place for it to go, which is up. And so when we're looking at a rising interest rate environment, we're looking at the bond market and we're saying, okay, we're probably going to lose money. And when you look at that, you kind of just want to, it influenced the way that we had looked at our fixed income investments. We wanted to save money. We wanted to lose as little money as possible, as like sucky as that sounds. But that was kind of where we're at because we were predicting that interest rates were going to rise. So yeah, that's how the US market looked. And if you want to change the next slide, we also looked at other places around the world too. We looked at Europe, and their return was pretty comparable, about 50 basis points lower and a pretty similar standard deviation. But this is just looking at historically. When you look at interest rates in the current environment back last semester, and Europe, a lot of countries in Europe have negative interest rates. Most, if not all of them, have less than 1% interest rates. And so they were in a pretty similar place as us, but they had historically been having negative interest rates. And so we figured that this also wasn't a very good place to invest because, interest rates would probably go higher at that point. So we figured that this wasn't a very good place to invest in either. The next slide. After that, we also looked in the Asian and Pacific markets, and this index is going to include things like Japan, Indonesia, Australia, that area, and Hong Kong, and it had a lower return at 2%, but also a lower standard deviation at 2%. The only thing that concerned us about this was something called currency risk. With this index, it was denominated in Japanese yen, and so I'm going to try and explain currency risk, which is a really hard thing to do, but I'll try my best. So if you can bear with me for a sec and then just try and follow along. Let's imagine that I have, I'm going to take a trip to Japan. I have $1,000 US. I'm going to go to Japan, convert that $1,000 US into, let's say, 1,000 yen. So 1-for-1 exchange rate. Let's just take that for example. And I buy a Japanese bond for 1,000 yen. So a couple of years pass, I get my 1,000 yen back, but now I need to convert that those yen into US dollars because I live in America. I want US dollars. But in that meantime, the US dollar had weakened to, let's say, now instead of 1 yen for $1, it's now 1 yen for 50 cents. So now I have 1,000 yen, and then when I convert it back into US dollars, I'm only gonna be getting $500. Compared to the $1,000 that I already that I had converted into yen before, and now I'm only getting $500 back, and that was only because the US dollar had weakened. Nothing about the company, nothing about the bond. It was just that the US dollar had weakened. Same thing on the other side too. Say for example, the yen weakened. So now instead of 1 yen for $1, it's 2 yen for $1. So now I have to give more yen for less US dollars. And then I have 1,000 yen. It's 2 yen for $1. Now I'm only getting $500 back. So same thing on both sides of the spectrum. If the US dollar weakens, then you get less money. If the yen weakens, then you get less money when you convert it back. So that was a big concern with us with bonds that were not denominated in US dollars. And it really affected the way that we invested overseas. And so since this was denominated in Japanese yen, there was currency risk. And so we weren't ready for that. So next slide. And then the last kind of index that we looked at with bonds was emerging markets. A lot of these countries overlap with the Asian Pacific markets and emerging markets. But when you look at the returns, it's 8% return, which is good, but also standard deviation is like 9%. And this was denominated in US dollars, so there was less currency risk at that point. But we were not prepared to invest in emerging markets with this return because it was pretty risky. With these kind of metrics, it's almost like an equity. And given that we were already investing 80% into equities at the time, we didn't want to, invest in more things that seemed like equities, because at that point bonds wouldn't be a cushion it would become aggressive. And so we eventually ruled out emerging markets as a whole. And then so when we look at all of these regions together, US, Europe, Asia, and emerging markets, and you compare their returns, we reasoned that the US was probably the most reasonable market to invest in with bonds, mostly because of, like I said, currency risk. We wanted to stay with our currency, and we were forecasting a weaker dollar in the future too, so we did really want to stay away from currency risk. Also, there's interest rate risk in other countries, political risk, especially with countries in like the Asian area and smaller countries. You kind of just don't want to mess with that. And then also, when you're investing overseas and say like a bond ETF or something, there's going to be a way bigger expense ratio than if you were to invest in like, domestic US bonds. So we didn't want to try and, be super aggressive with our bond portfolio, and just decided to stay in the US. So, yep, that was why we chose the US. And then, so now to kind of talk about the different sub asset classes, like we chose the US. Now, which sub asset class are we going to invest in specifically? And if you look at this graph, these are the different classes that we have. We have, like Brian was saying, short term, intermediate, long term. We have an aggregate index. We have preferred stock, high yield, treasuries, corporates. And so we just took the returns from these different sub asset classes and the standard deviations. And you can see that it kind of goes along with reason that like short terms are going to give you the least amount of return, while long terms are going to give you the more return, especially corporates. But when we're looking at our decisions for last semester, if you want to go to the next slide, there were a couple of different metrics that we use besides just return and standard deviation. We had replaced the return with yield to maturity, because we felt that yield to maturity was going to give you a more current estimate of what you're going to be getting on those bonds. Especially because like you can look at 5-year, but you don't know how interest rates have changed in those 5 years compared to yield to maturity. It's already accounting for current interest rate climate. So we thought that our yield to maturity would be a good measure for what we're going to return on these bonds, especially since yield to maturity by definition is the return you'd get if you held it to maturity. So we kept yield to maturity. And then another measure that we added was duration, as Brian had described as well. And so what duration is, let's take, for example, the government aggregate bond, or the government aggregate index right here. So its duration is 7%. So basically what it's saying is if interest rates were to change by 1%, then the value of that government aggregate bond is going to change by 7.13%. So it kind of, again, measures the sensitivity of that bond to the market. And so let's say, for example, interest rates rise by 1%. And since we were forecasting rising interest rates, this was a very relevant thing. Interest rates rise by 1%, then this government aggregate index is going to drop. The value of this index is going to drop by 7%. And inversely, though, if you think of it the other way, say interest rates drop by 1%, then the value of this government aggregate index is going to raise by 7%. So on both sides of the spectrum, there's room for losing a lot of money, but also gaining money depending on interest rate environment. So that was a metric that we really looked at. And eventually what we settled on was we wanted to invest in 10% in corporate short term and 10% into a government aggregate index. And the reason for this is because we had three goals. The first one was we wanted some income. Like I said before, with rising interest rates, you're probably going to lose money. If you can get any income or any return, you're doing good. So the way that we thought we would achieve that was through corporate short term on the left side of the graph. You can see that the yield to maturity was 1.6%, pretty low duration, pretty low standard deviation. And so we thought that was a good way for us to get income. But our other two goals were we wanted to preserve our capital, be as safe as possible. And we wanted to preserve our capital. And then, yes, if there was further economic downturn, say, for example, interest rates were to drop even more, like maybe even like at zero, we wanted some duration to help us get that upside. And so we thought that both those goals were achieved with the government aggregate index, where government's not going to default on your bond, and pretty high duration. So that way we're going to have a bigger upside when if interest rates were to drop. So to wrap it up, basically we invested 10% corporate short term, 10% government aggregate to fit our goals. And yeah, so now I'm going to pass it off to Allegra, who's going to talk about our green bonds.
Yes, sir. Okay. Brian, can you make sure those are the
Y-
slides though?
Yeah, let me just refresh.
To have all the updated ones?
I
It doesn't.
think.
Yeah. So,
Okay, no worries. It's this one.
so
All right, cool.
all right. All right, sweet. Thanks, Ethan, for taking it away. So we know sustainable development is one of the most important goals that the human race is working to achieve, right? And so I'll be diving into what are green bonds and how we can invest clean. So green bonds are a type of fixed income instrument, and it is a debt security by issued by a government entity or corporation that is trying to raise capital from investors to use for projects that contribute to climate resilient economies. Essentially, what a green bond is, it provides finances to projects that respect certain environmental criteria. And so in this, and we see here like its main uses, what it's used for its proceeds. We see its high use in energy efficiency, clean transportation, waste management. A lot of it is in infrastructure and power plants. Uh, so this is really just an option for private companies or public institutions to support climate and environmental friendly projects. So moving on to, there are 6 types of green bonds, and this is there's a lot to it in specifically, but I'll briefly just say it. So the first one is use of proceeds bond, and all the proceeds raised by the bond are reserved by green projects in the issuer's portfolio. We then go to use of proceeds revenue bond, which the sales made by the bonds are set aside for refinances in green projects. The project bonds are proceeds raised by bond sales, and it's for a specific project. Securitization is proceeds raised by bond sales, and they're pooled and reserved for green projects. Covered bonds, kind of similar to a loan as well, but it's the proceeds are raised by bond sales and they're reserved for eligible projects included in a covered pool. So similar to also project bond, it's specific projects, and then loan is proceeds by bond sales earned for eligible projects or secured on eligible assets. So, all right, going into background and a little introduction to green bonds. If we do a little history check, in the 1880s was the start to the progressive era, and as we know, the rise of industrial America, industrial revolution, and that's when we see a growth of manufacturing. And how this comes into play is that was I would say that was a time where a lot of good things happened to the human race, but a lot of bad things. So the good things that it brought up a lot of innovation, instead of a new idea, manufacturing, so on. It changed the world, right? But I see a lot of bad on it as well because if we know it was just gruesome working conditions and it the pollution that was caused from it. So my point is about global warming has been increased per decade since 1880s, and about 98% of the globe has been exposed to an increase of temperature since then. So that's kind of concerning, and but this has been a high concern for economists, and this is a new risk to the markets, to the economy, right? But we see that the damage has been done already, and the investment to fund these disruptions are just massive, right? And public institutions cannot simply finance these. So that's when we bring out the big guns. We got private corporations, right? Uh, and private capital might be able to finance the green economy and all the innovations that occur from it. And So that's where we come with the first green bond that was issued was in 2007 by the European Investment Bank, which followed in 2008 by the International Bank for Reconstruction and Development. And so, like, what they do is, apart from their original containment to energy and waste and water management, they also work on land use, waste management, sustainable transports. So they're working on sustainable development. Uh, but we really start seeing an appearance to green bonds in 2014. That's where it started growing. But what made it grow remarkably was the 2015 Paris Climate Agreement. And I'm sure most of you know what the Paris Climate Agreement is, but just briefly, it's an international treaty on climate change, and the agreement includes all major countries to commit to cut their climate pollutions and strengthen those commitments over time. You press the button. Yeah, so just to show you guys how much of the green farm market grew. In 2007, it went from 1.5 billion to 2008, going into 389 billion. So just remarkably increasing. You can go on that. All right, so how green bonds performed. To point in 2019, we experienced a downward movement of rates, and so financial performance of the green bonds took this to its advantage. And diving into one of the largest indexes, the Morgan Stanley Capital International Global Green Bond Index has gained a strong increase. So we see a 6.50% over the year after a year in 2018 being in the red zone of negative 0.72%. Uh, so we see high growth, um, very popular. Green bonds issues broke records in 2019, 255 billion worth of new securities added to the market, and that was up from 167 billion in 2018. In the US alone, there are more than $850 billion of green bonds outstanding, and it's forecasted for up to 1 trillion in the future years. Uh, to know, I put a little the Luxembourg Stock Exchange. Yeah, pretty interesting. So the JP Morgan Chase was the largest green bond underwriter in the global market in quarter one, quarter three in 2020, with a total of 12.9 billion in green bonds. And then one of the most popular green bond listing platforms is the Luxembourg Stock Exchange. This is all European, by the way, so this is all in euros. So 16.3 euros worth of deals traded across its venues in quarter one, quarter three in 2020, of which only 12% were certified. So, but the largest listed green bond in quarter three was about 3.0 euros, and it was an 8-year bond from KfW, and they work on infrastructure. All right, a little summary of the green bond market. Recent one for 2020. We see that corporate embraces the green label. So financial and non-financial corporate issuers have been the biggest source of green bonds in every quarter since about 2018. And in quarter three, 2020, financial corporate issuance reached 17.6 billion, which was an 18% increase from the previous year. So the largest of the financial corporate deals was a debut green bond from Munich Re in the form of 1.25 billion. And again, these are all European ones. Go, yes. Um, back. There you go. So this one's the interesting one, the non-financial corporate deal. So one of the largest issuers for green bonds were German auto manufacturers Volkswagen, which issued green bonds to support their transition to electric vehicles. So this is pretty good news for green bond investors who are seeking to diversify their portfolio. And then going on to the use, quarter three use of proceeds, just graph shows you how green bonds are being used. So mainly we see energy and infrastructure. So you can move on. All right, the green bond market summary for top 2020 countries. We see USA top the country rankings. The country rankings for the end of quarter three are led by US with 32.3 billion, Germany with 21.4 billion, and France being 17.8 billion. While Chinese issuance is 9 billion and it still has a long way to go to meet its total for 2019, which is 31.4 billion. It still remains the largest country with the largest cumulative total after the US. I believe China's like 105 billion, and then the US is like 200 and it's pretty high. But if you go on the next slide, I'll be explaining how China's the main driver in the developing countries. So markets in low and middle income countries are the most exposed regions to climate change risk. They face an unprecedented challenge to decarbonize their economies while maintaining a sustainable economic development. So it's hard to like balance the two. But we still do see a high growth of green bond markets, especially in developing countries. The first green bond issuance from the LMICs, which that stands for low and middle income countries. Everyone knows. It was it took place in 2012 in South Africa, but the superstar here in the global green bond market was driven by China, with the East Asia and Pacific region accounting for 81% of the market. Huge. And in 2014, they amounted from 4.5 billion. In 2015, they got up to 42 billion. And then lastly, in 2016, they like raised double than that with 81 billion. So that is just a tenfold increase just from then. Even though green bonds accounted for only 1% of bond issues at the beginning of 2017, it has seen a growing investor interest. And although China is dominating the market, India is also making an appearance in this market as well. So climate finance is we see it has increased by 25% over the previous years. But this is all really go back thanks to China for its rapid growth of installed renewable energy capacities and the commitment to better land use and energy efficiency in many parts of the world. So you can go on forward. This is just a little overview of what I mean by what I recap with green bonds. So it's a debt security, a fixed income instrument. Proceeds are used to finance environmental friendly projects. Green bonds outperformed in 2020, and green bonds represent no more than 5% of a bond issue. So it's a small market, but it's definitely seen to grow remarkably and increase. So invest clean. Thank you.
All right. So with that, we'll conclude our fixed income workshop and we'll open it up for questions. So I have a question for Allegra actually. So like is there one regulatory agency that has to check that it's actually a green
Yes.
bond?
Yes. So it does go through a clearing, and a little similar with like ESG, Bloomberg stuff, but it has to go through a climate bond initiative. And on the slide, I think I skipped this one where it does explain it, but it basically tells you the the characteristics of like the process if it's approved or not. But it does go through a process where it has to be certified by the Climate Bond Initiative, and that's when it goes through like an external review, see if like the projects really do meet the requirements. But it's a long, yeah. I can look more into it, but it does go through some clearance.
Yeah. Well, that's good that they're not just putting green in front of it. Go ahead.
I have a few questions, if you guys don't mind. By the way, I'm a new member in this club, and that was a great presentation. You guys did great.
Thank you for
So
joining.
thank you for that, of course. I do have a few questions. Number one being, when you're selling a bond, do you have the freedom to sell it at whatever price you want, or is it automatically calculated?
Ethan, you want to take this one?
Yeah, I could take it. So what you're selling it at is going to be, it's like determined by market forces essentially, but it's mostly due to interest rates. Say for example, I had like a 1% bond. I bought it for $1,000 and it's giving me a 1% coupon. So it's like, I think it's like $10, right? And then a year passes, and then interest rates drop to, let's say, 0.5%. So now, because I have a bond that's giving me like a 1% coupon, which is $10, but then their alternative option is okay.
Is it you?
No, it's not me.
Oh.
Okay, I just figured we were playing music, but I guess not. But yeah, like I said, their alternative option now becomes that they can, like, in the market right now, they're gonna get a bond that's only giving them 0.5%, which is $5. Now you're holding a bond that's giving like a higher coupon, and so now your bond is worth more than a bond that's only giving a $5 coupon. So it's all dependent on that interest rate.
Yeah, I know how to do bond valuation. I was just wondering if you have the freedom to sell it at whatever price you want.
Oh, like oh, okay, I think I know what you're talking about. I mean, you can, but you would have to find a buyer who would be willing to buy it at that rate.
Mhm.
So I think it's better just to sell it at market. And the market's already determined by those, buying and selling. So yeah, I don't know if that answers your question.
Yeah, that answered my question. I was just wondering if we had the freedom to sell at whatever price we wanted. The other question I had is, are you guys surprised that the green bond market didn't go down as a result of the US backing out of the Paris Climate Agreement?
From what I've read, they're going back to it. Actually, Biden signed a treaty to
Yeah.
yeah,
Biden, when he took office, he's definitely decided to go
Trump,
back, but Trump
but
did
Trump
back
left,
out.
did fund back out. But we see green bonds are really often outside of the U.S. too. It's really big in Europe and in Asia. So um, it's more global. It has a lot of global growth, and I can only see it increase from here on out, due with Biden signing the back to the treaty.
Yeah, so even then it's diversified, I guess. Like even though the US backed out, there was still plenty of other countries that were hopping on board.
So I have a quick question. I think we're all pretty curious about bonds because it's so easy to trade equities because they're pretty straightforward. So look, if I'm an investor, I want to buy some bonds right now. Do I really care about green bonds? About the environment? What kind of what kind of incentive do I have to buy a green bond? Do I really care about that these green bonds are contributing towards climate change if they're only making up for 5% of the market?
Just through the environment then, and right?
Well, no, I think the thing is, it's like what other incentive is there to like buy a green bond? Like, can you deduct taxes from them? What incentive do I have to buy a green bond? Are they cheaper?
Like a regular old blonde, just these bonds finance?
The way I would probably compare it is like if I take a company like, Patagonia or any other environmentally conscious company, what's my incentive for wanting to buy from that company? And it's because it makes me feel like a better person for taking care of the earth. So when you think of these green bonds, if you're like someone who's constructing a portfolio for a client, and then say the bond yield relative to a corporate bond yield is marginal, I can not only say that like I can not only say that like yeah, you might be losing like 1 basis point, 5 basis points less, but you're helping to like save the earth. I think it's a informal quality that you can tag on, and it's showing that like I think a lot of people, especially nowadays, aren't just looking for the cheapest thing or the thing that's giving the highest return. They want their dollars to represent who they are. So if you're looking for money, maybe not bonds, but if you're looking to like put your money in things that you believe in, maybe green bonds could be for you.
Yeah. Okay. Yeah,
And it's a way of, but to add on to that, they're still new, I believe, and a lot of it is unregulated. Um, there still needs a lot of work to it. Like I said, this only represents like 1% of bond issuance or 5%, but um, we we do see it's just growing from here. From you know, the more years to grow, the more things it has to offer. So it's something to look at for right now.
definitely. Yeah, this is a great presentation, guys. I loved it.
And this is a bit of an unfortunate answer to Andrew's question, but it's a very real answer to it. And there's a social movement towards green to gold in that businesses are in it to make money. And a byproduct of making that money is to have some form of social effect. So if a business can look good on paper, taking things like green bonds, then they're likely going to make more money. So unfortunately, it's just a psychological, there's more than just psychological, but the green to gold concept does happen to deal tremendously with this psychological looking good on a business's balance sheet. And that's something that Ethan actually touched up on as well. And because of that, that can drive things, even though they may be a less performing bond than other bond, the fact that it looks good and people can then jump on board to it makes it an attractive bond to purchase.
Right. No, that's a great point, Albert. Like I said, sustainable development is one of the one goals that the human race is trying to achieve, and what companies are looking to to do is sustainability, environmentally friendly, all that stuff. So it does it could be just something to just make the company look good and pass its ESG criteria, right?
I had one more question, but it is a question about equities, and it's related to one of the topics that was covered, still the Green Deal, if you guys don't mind. So you guys expect the bond market for green bonds to go up, but let's say, for instance, U.S. enters the Green New Deal. Would you guys expect the equity market for renewable energy and things like those equities to go up, or do you expect them to go down because of perhaps regulations set on that industry?
I would think if there is, I mean, I don't know, like we don't know what the final form of the Green New Deal pass would be, but I would assume it would have money for companies that are gonna enroll in these like sustainable programs, right? So I would assume that that tailwind of that new influx of cash into those sustainable companies, whether it's like more money for them to continue their research in sustainable investing or sustainable products. And I think that's going to be a tailwind for those equities that are in the sustainable space, or like the electric space, or like the renewable energy space. That I'm guessing it's going to be a tailwind if that passes, and if it has money for those like investments, like for those companies that are in that field.
And just to note that green bonds, it's its own market, right? So I guess that's, saying like, oh, green bonds outperformed 2020, but like it's really its own market, own sector. Not really comparing it to anything else, but it's other green bonds. Would it affect? That was a great response, though, Brian. Thank you. Thank you for that.
Yeah, thank you guys. I actually have class right now, so I gotta go, but I look forward to your guys' next meeting. Great
Thank you guys
presentation.
for coming. Thank you, everyone, for coming.
I think we'll end it here. Thanks
We'll end
everyone
it
for
here.
coming.
Great
Thank
job,
you.
guys. Good stuff.
Thank you.
All right.
See you in class.